Yep.
Okay, hello everybody. We just hit the
everyone.
broadcast button. I want to make sure that we're broadcasting, so if somebody doesn't mind putting in the chat box there to my hello to know that you can see us, that would be awesome. I'll do a little housekeeping here for Zoom, which you're all accustomed to by now, I'm sure, but please feel welcome to ask questions in the chat box or if you're on a computer. You can also use the Q&A and we'll be monitoring them as we go along. There's no reason not to ask the questions as we go along because we'll hit them throughout the presentation. And thank you everybody for being here and sharing your time with us today on this Thursday. We are coming from you from multiple locations, just like CNN says. We're so glad that you joined us. Today we have not only an interesting opportunity, but a long-time good dear friend of mine, Mark Cacavo. I think we've known each other for 15 years, maybe longer, back in the day. Mark is going to share his really interesting background and in the finance world, which has led him to be involved in this pre-IPO secondary market. And I will repeat again that we've been good friends for a long time, and he's a super smart guy, and so you're going to enjoy this. I would say to you now at the beginning of this, if there's somebody that you would like to hear this presentation, the RSVP is open, so you're welcome to share the link with them. If they want to come in through halfway, it's fine. And then we'll also, of course, be sending your information to Mark, and he'll be sharing the presentation with you after the webinar, as well as posting a recording this on the Family Office Insights YouTube channel. So with that, the only thing I would like to add, and I'm not going to steal Mark's story, but me and others, and not everybody who is an investor, finds liquidity, invest in private companies, and then finds another shiny object that they want to invest in. And so they often need to find liquidity. And this is not necessarily just for that fact pattern, but others who are looking for liquidity in privately held companies, and those that wouldn't otherwise be able to get access to those secondary shares in private companies before they go IPO. That's really the topic of discussion today. So welcome and thank you. Mark, thank you for being here.
Thanks a lot. Well, as Art mentioned, I think we have known each other for about 20 years, and it was back when I was at US Trust Company. So I used to work quite a bit with venture capitalists, their limited partners, and the family offices at US Trust that would potentially have big blocks of stock that they received from when their companies that they invested in were private. So this has kind of been nice. In the past year, I've gone back to focusing on family offices and in particular the pre-IPO market. And it's been incredibly active, and there's been a tremendous amount of changes that have occurred in that marketplace that have really led to why it's become so popular recently. I was speaking with someone yesterday who mentioned that out of nowhere, there's just been so many inquiries coming in, both on the sell side and buy side, with respect to private companies that were in the, let's call it 0 to 2 year timeline to IPO. So it's certainly an area where I'm seeing activity, and hopefully today I can go through some of the story of why it is what it is right now, and where the opportunities are. And then, also where some of the big changes have come, particularly in valuation. So with that being said, why don't I just get into kind of where some of the changes have occurred. So
We can see the first page.
You can, okay, there we go. So just as a little side note, many people ask me where the name Bombora is from, and I kind of thought it was a clever analogy to the IPO market. So a Bombora is basically a formation of land that sits somewhere near the surface of the water, but away from the shoreline. And often, if surfers can find them, they particularly are in Australia, you basically get a chance to ride the wave much earlier than other people, than the people surfing the same waves near the beach. So I like that analogy as it kind of pertains to the pre-IPO market. I've been surfing for a whopping 5 years, so it's just a small passion right now. Anyway, so where are we in terms of the venture capital market from, say, 10, 15 years ago versus today? So 10 years ago, what used to happen, you had about a 1 to 2 year timeline where your friends and family and your seed round happened, and then the venture guys got involved, and then the private equity guys. And then if there were some folks who were taking too long to get liquidity, there was an LP secondary market. And that, the timeline was around 6 to 8 years when there was some sort of an exit on the position. What we've seen now, though, has been this massive evolution to these companies that are going public much larger, and venture funds are supporting them through funding well into the Series E, F, G, H rounds. Whereas before, I believe Google probably had a D round, maybe an E round. So in the next slide, I think this is really a perfect slide for trying to represent what's occurred. And if you look back to the old VC model, VCs were bringing companies public and at valuations of $500 million. And even, Google, Amazon went public at $571 million, not billion. And, now it's just a different story. So if you think about it, Google went public at 767 million, and Alibaba went public at 170 billion. And even if you compare apples to apples in Alibaba versus Amazon, you could see just how different 15 years makes. So as I mentioned earlier, VCs are just really investing in these companies for the long haul. And whereas before they used to allocate beginning in, let's say, the B, C, D rounds of venture investing, now they're actually participating in the seed rounds and the A rounds and funding all the way through to IPO with those mega rounds toward the end of the IPO timeline. And, unfortunately, as I mentioned before, the push from 8 years to 12 years was because in the prior model, VCs could hang on to the stock and deliver it to their limited partners later after the company had been public for a year or 2 years. But then there was a lot of pushback from pension funds and some of their larger institutional investors that basically said, we are not paying you 2 and 20 to manage a company that you invested in privately in the public markets. And so there was this kind of push and pull between the VCs and the LPs. And what was happening was the limited partner, after the fund distributed the stock, then still had tons of growth left in that company. So that model's shifted now. And as we see a lot more big funding rounds later on and squeezing out kind of that, let's call it 30 plus IRR, and bringing a company public probably between the 20 and 30 range, as opposed to, let's say, 30, 40, or 50 like they had 10 years before. In terms of liquidity, the longer timeline has also created challenges for employees, especially early employees who may have a significant amount of net worth tied up. So to the extent that they have some ability to get some liquidity through their company, they do that. But now there obviously is another market that they can tap outside of the company. And I'll explain how COVID's really impacted that market. On the VC side, they're actually turning around, and if they happen to have a winner and they do want to hold it through to IPO, they may actually take a little bit of money off the table in, let's say, year 4 or year 6 to deploy back to limited partners. It's very self-serving because they want to return capital to the limited partners with the timeline being longer. It's actually taking them, they have to keep the LPs engaged and they would like to at least have a new fund every 2, 3, at max 4 years. So with a 12-year timeline, if they only have a couple home runs, they really have to do a good job of keeping their LPs happy. So as I mentioned before, all the big venture capital funds are investing at earlier stages. So whereas before, there were a lot of opportunities for family offices and ultra high net worth investors in the seed rounds or even the A and the B rounds, they're kind of getting squeezed out by some of the bigger funds, especially when the bigger funds can continue to support those companies all the way through to IPO and very late stage financings. And so unfortunately, the money that they're taking in has traditionally been a mix of family offices and institutional investors. But when you're raising a $900 million fund, you're going to just target institutional investors. And the bigger funds have basically squeezed out family offices and ultra high net worth investors. So what's happened is the family offices are now left with investing in younger, less seasoned venture funds, to kind of chase after those big success stories or the next unicorns. Another problem you had was the secondary market used to exist where a limited partner couldn't commit to the capital commitment for the rest of the fund life and wanted to sell their position in a fund. And that used to be a pretty good market for family offices to be able to gain a little bit of extra liquidity. Family offices to be able to deploy a little bit of capital into premier funds. But now that business has been taken over by places like HarborVest, Collar Capital, Landmark, where they know exactly what the positions are in a portfolio. They probably have valuations already established such that they can very quickly bid on an LP interest, and basically, again, have now squeezed out the family offices from participating in getting access to those premier funds that way. So what's happened? As you see in this slide, the IPO timeline stretching out to 12 years, this pre-IPO secondaries market is now pretty active at years 6 through 12. So I would say that most companies with valuations over about $500 million, you're seeing that they can begin to get some liquidity after the C, D rounds in the private markets. And the mix, as I'll show on a later slide, of who the buyers and sellers are is quite varied, but for all very different reasons. So with that happening, family offices decided, let's go and try to buy some of these directly. And they started approaching employees. People started hearing about employees grumbling or about liquidity. The banks couldn't really lend against those positions because they weren't transferable or pledgeable. So the only way that the employees or early investors could get some liquidity was to actually sell their position privately. Now, of course, the company has what is known as ROFR, or right of first refusal, on purchasing those shares. But as I'll point out on another slide, during COVID, companies are really keeping cash on the balance sheet, and they are not exercising right of first refusal when these positions are coming to them for transfer to a new buyer. So they began shopping, and one of the early examples of this was Facebook, and there was a very active pre-IPO market in Facebook, both from hedge funds, from a couple of family offices, from folks who were early investors, early employees who left the company that had stock. So it's kind of like, I would say, when Facebook, the year before Facebook went public was really when this market began to grow. And now it's probably extended to almost every pre-IPO company with a valuation over 500 million with good growth prospects. And again, it doesn't have to be the IPO that is the be-all end-all, because we are seeing venture capitalists looking also for acquisition to sell their companies prior to going public, rather than going through, in some cases, a lengthy or delayed, as we have now, given the COVID situation, IPO market. Here's a list I thought I'd put out of some of the most actively traded companies prior to going public, and I'm sure that you're familiar with just about every one of them. I think it's noteworthy that one of the common denominators to all of this is the companies that end up going public to some extent have some form of venture backing along the way, and in many cases actually have premier venture capital funds involved. So that's kind of one of the key things you want to look for when you're looking at these types of securities is, who else has been involved with the company and backing it? Have they backed through the entire all of the rounds? To what extent do they have ownership? And also, how much do the employees own? So this slide, I actually just wanted to point out a couple of folks who have become more active with respect to buying these secondary positions. And the family offices and multifamily offices, for sure, have been more active. I think they are finding that they can put together a portfolio either of names that they follow or are aware of, or in some cases, it may be almost a shadow position to a successful investment that one of their venture capital funds made, and they're just looking to kind of add to that position in the private market. We're seeing pension funds and mutual funds play very heavily in the space, especially in that last year of IPO, of pre-IPO. And what happens during the IPO process is a lot of these larger fund managers like T. Rowe Price or Fidelity basically have the challenge of making whole on their entire allocation on the IPO. So what happens now is if you have a 35 or a $26 billion company like Airbnb, the portfolio manager knows he probably needs to buy $75 or $100 million worth of that stock either close to the IPO or shortly thereafter the IPO to properly weight his portfolio. So that what they're doing now is actually buying some of those things in the private market ahead of time and getting an early position. Hedge funds have been very active in the space for a long time, but we're seeing them become much more aggressive in terms of bigger positions. So whereas before they would do side funds that maybe did positions of $3, $5, $7 million, and now we're seeing hedge funds take $50, $75 million positions from earlier investors, from other venture funds that are looking to exit. So there's a really active market for people to participate in. And then lastly, but certainly important with respect to today, employees, especially the many that were laid off in Silicon Valley, have created a whole new source of stock coming into the marketplace. And one of the things that has been very interesting to watch is how the companies are not exercising their right of first refusal, and there are plenty of buyers lining up for those shares once they're available. And in some cases, you're getting chances at companies that are not, don't appear that often in the typical pre-IPO market. Things like Palantir, like SpaceX, Airbnb, there are plenty of buyers and sellers around. But you had some positions in some other companies, some cloud companies that really are not widely held. So when they come to market, they get taken up pretty quickly.
Hey, Mark.
Yeah.
You mind if I ask a question here?
Sure.
Back to the prior slide, not this one, but not that one, the one before that. Is it fair to ask you, and it's okay if it's not, that it's not a fair question, you can just tell me. When you said it's important to think about the data point of whether these early notable venture funds are involved as one data point, and whether and what percentage of the company is owned by the employees. Is there a general statement you can make about that in terms of which one you weigh more than the other? And if there wasn't the Silicon Valley fund involved, should you just bail and move on I know that was a dramatic and I set you up, but can you just comment about those two data points?
Well, I think everyone knows that the larger venture funds, if they happen to be an investor, are in it for the long haul. And especially if you're already in that C or D round and they've been supportive for the A and the B and the C rounds, that there's a good lifeline as the company matures. The challenge you get is with some companies that don't have strong VC backing, and maybe it's funded completely by friends and family, is you're just not 100% sure if there's another kind of COVID situation, if they can quickly do a raise and shore up the balance sheet, as many companies have done in the past couple months. So I find it to be an important data point. It's not a be-all, end-all, because certainly if a company is making great revenues, then they don't need extra money because they're well on their way to profit, or they're profitable already, and it's just a matter of right timing when they go public.
Great, thanks.
So I thought I'd show you a list of some of the names that we're very active in right now, and these are companies that are traded almost at least a few times a week. Obviously, some of them have been thrown into the spotlight due to COVID. Companies like Postmates and DoorDash, Instacart, and some of the other delivery, or in the case of online education, something like Coursera, or let's say Masterclass. All of those companies have done very, very well during COVID, and you're seeing an active market for those positions. One that I always like to ask this, and maybe Art, you can take a stab. Art, what's the most valuable company on this page?
Stripe.
Very close, but no. It's actually ByteDance. And most people don't know even what ByteDance is. But if you ask your 17-year-old child who ByteDance is, they won't know either, but it's TikTok.
So most people, including me.
So what's interesting is as people kind of look through some of these companies, it's not only about what's on the surface and of these companies. So for example, a 23andMe or an Airbnb, 23andMe is not about making money determining what your genetic, your ancestry is and your family tree. They're collecting data and they're selling data. And what a lot of people don't realize is that Airbnb actually is challenging the $300 billion piece of American Express for travel, and trying to get basically become the travel agency for the United States. And they have it on the private market, and American Express dominates it in the hotel market. So I think there are so many different aspects to many of these companies. It's super fun to kind of dig in and try to get as much information as you can and see if something becomes available. But to the extent that you're following some already, sometimes it's a matter of just being patient, and other times it's a matter of something has come up. You have about a few hours to tell us whether you would be interested in it, because it's going to be sold. And so it's a unpredictable market in terms of the timeline of things. So I thought this was very important. COVID has kind of shaken up this whole model. And it's made it even more dramatic. So companies are going public much later, and now you had companies that were planning to go out in 2020 that are now looking at 2021. You'll probably see a few do reverse IPOs into special purpose vehicles or special SPACs. I think the other day some people may have read that Bill Ackman had started $1 billion SPAC specifically to be used as a reverse IPO for some unicorn that exists out there. So it will be very interesting to see what happens over the next half a year with respect to whether the IPO market truly opens up, whether the M&A market is very active, or what's going to happen. As I mentioned earlier, the layoffs in Silicon Valley have brought a lot of additional inventory. So it's just been, there's just been no shortage of different names to trade. And with a lot of the companies leaving, employees leaving companies, there's fresh valuations with respect to the option exercise that many of them have. So there's good data points with respect to valuation. So how are family offices and ultra high net worth investors participating? I think they're really just being opportunistic, and they're paying attention to see some companies that if they had a chance to buy them when they were private, then they would do so rather than wait for the IPO. We also are seeing a lot of positions come to the marketplace from seed investors, and that's actually on the next slide where, let's see here. So a family office or an ultra high net worth investor may have invested in a company that has done phenomenally well. So I'll give you an example. There's a family office that's based in São Paulo in Brazil, and they had funded about 10 different seed investments, and 2 of those investments actually are unicorns. So I think they invested in 2 of the, call it 5 unicorns in Brazil. So they're incredibly happy with their stroke of luck on that. And they're participating in the A, the B, and the C round. And now they've been squeezed out by venture capitalists in the US on both of those names. So for them, they can't continue to make the capital allocation needed to not get diluted. And why not take a little bit of money off the table and redeploy it? So we're seeing that as certainly a way to kind of continue to grow the venture portfolio that they already started with these successful investments, but they're not being too greedy to wait through IPO and then beginning to look for liquidity. So one of the key considerations and the million-dollar question is, how do I know that I'm not getting ripped off on valuation? And in its simplest terms, venture investing and buying companies pre-IPO is an art. It's not a science. And you're going to take in as many data points as you can get your hands on to determine where, okay, it's traded here a month ago, it's traded over here 3 months ago, there's some news that's happened in the company. This particular seller is a little more aggressive. This particular seller is more patient. So there are a lot of moving parts with respect to the spreads, and COVID actually has caused the spreads to be very wide. So for example, in Airbnb used to trade well above $120 a share. And during COVID, I saw it trade as low as the 60s, and now it's back to around the high 70s. But in reality, there's a lot more data points for valuation. So with all the VCs raising these spot rounds in the past couple months, you're seeing a valuation marker that you can immediately use. So maybe that company hasn't raised money in 2 or 3 years, but suddenly it did raise money, and now you have a data point. So sometimes there's a little bit of a void if the company is doing well and is growing its revenue and doesn't need to take in money for the 1 or 2 years before IPO. But in this case, you're getting a nice data point that's current. And then also you have some publicly traded companies on some of the cloud companies. Another interesting comp is a company like Coursera, which is online learning. So their peer that's in the public market is called 2U. And 2U, I think, has a $2.2 billion valuation. Coursera, most people agree, is a much stronger platform, and it's trading at around 2.2 now. And there's something to be said for, upon IPO, that a lot of people will rotate out of something like a 2U into a Coursera, as it is the better of the two. So those are all these different factors with respect to, is it a name you absolutely want to get pre-IPO? Is it a name that you only want to get if it's at a great price? Is it a name you even care about? So
Mark, that's super interesting to me. for the reasons that you suggest, and all those data points, it's complex, right? It's not a simple decision. However, is it also fair to say at the end of the day, even though it's not an auction market like the stock exchange, it is a willing buyer and willing seller? So it's essentially what someone's willing to sell and someone's willing to buy it for. So sans all those data points, you still have to, there has to be desire on both sides of the trade, right?
Without a doubt. So what we're finding is there are enough data points where people have a pretty good idea where the bid ask is, and then it's just a matter of kind of splitting the difference to the extent one side or both sides are willing. But in general, I find it to be active enough right now where there aren't, transactions are sort of continuing to get done. And that's, it's kind of like on this page with liquidity, transactions still have to be negotiated, and there are plenty of things that can go wrong along the way. I liken it to like a mini M&A trade because it's very private, it's negotiated. The platform that I'm a part of, which is called Rainmaker, the platform is made up of around 30 people, half of whom have their own advisory firms covering venture capital funds, covering family offices, similar to mine. So between all of us and our network across the 25, 30 brokers, we get a lot of things done. And that's why our transactions have a tendency to be a little bit larger, because they just get placed within our own network and there's a little more discretion to who the end buyer is. And then, as I mentioned before, VC-backed, I find it to be an important piece of the puzzle. And then, obviously, everyone on the call, I'm assuming that they're accredited investors, and the pre-IPO securities market's only, the private market is only available for accredited investors. So, with that being said, I certainly I would welcome some questions, and what I will do after the presentation is over and I get some of your information from Art is I'll send everyone a copy of the presentation so that you could read through it at your leisure, and feel free to contact me with any questions from the presentation, and happy to engage on any particular situations or even show you what we have on our buy side book and our sell side book, and you can see some of the interesting positions that are available and size positions that are available. So with that being said, if there are any questions, I welcome them now.
Yeah, I've got one here, and I've got a bunch too. So we have a question, are there usually minimums for the investment? Also, are there any companies available right now, which you just kind of answered, but maybe you can give some examples without tipping your hand. And
sure.
Of course, as we expect, and appropriately so, what's the narrative around the fee structure?
Sure. So the minimum size ends up being around $500,000. In some cases, we have some investment clubs that actually will pool together 2 or 3 different people and maybe get to $600, $700, $1 million to do a particular transaction, and they'll put it in one SPV. So it's just a way to simplify for purposes of the company on the cap table, but also allows them to get access and meet the minimum with the help of a couple other people. I see other folks basically decide, I want to allocate $25 million across this. I will plan on making 25 investments of $1 million, strategically over the next 2 years, and I'll recycle my winners back into the pool once they go public, and just continue to kind of grow that almost pot of very specific money.
So we have, I have to take liberties and give a shout out to Matthew, who I knew he would ask a question because he's one of the smartest guys I know. So there you go, Matthew, you can pay me later. can you discuss your thoughts on online platforms for trading pre-IPO positions?
Sure. Online platforms like SharePost and EquityZen are perfect for employees, especially employees that have smaller positions. In many cases, they own common stock. They don't have the additional kind of bells and whistles of preferred. So it's a little easier to kind of standardize it for purposes of buying and selling. I think most of the positions that we're trading, because of the size, have a tendency to not want to be advertised. I'm working on something right now where the company is still in stealth mode, but one of the founders is looking to sell $15 million. And every person that I'm approaching, I have to clear through the company ahead of time before I even contact them, because that's how quiet they want to keep the transaction. So certainly, I think there's a good market for some of the smaller positions, but when it comes to the bigger positions, I find that, as I mentioned, they're like mini M&A trades, and there are too many moving parts to try to standardize it through an online platform.
So you're saying it's good for employees because it can be somewhat standardized?
Yeah, so they can basically, if they only have $30,000, they may be out there with 3 or 4 other employees for a total of 120, and an investor can come in and clean up all 4.
And then the heavy lifting for getting the company permission and doing all the regulatory stuff has been done on the platform in advance?
Not usually. There still will be a process for the transfer, and that's upon acceptance of a bid from a buyer. So it still has to go through the process typically, unless the shares were previously cleared and held in an SPV already. So let's say someone's investment club bought them, and then they decided, it's done pretty well. It's not public yet, but I'll sell it now. So they'll sell it out of the SPV. And in that case, there's no company involvement needed. So it just transfers to the new investor, and they now are the beneficial owner of that in the SPV.
So you may have answered it while I was looking at the questions. I apologize to repeat things, but on the fee structure, it's, you're getting paid to find a willing buyer and a willing seller, and then do all the heavy lifting in between. And I think it warrants explanation of what that looks like, meaning this is not an easy trade to do. You just can't put a CUSIP on it and sell it and buy it, right? It's not like buying a share. So you might want to talk about,
Sure.
Why you're getting paid handsomely and it's okay.
Sure. So one of the key pieces is information. So to the extent that a buyer gets comfortable with a particular price is usually a function of a lot of data transfer between the seller and the potential buyer. And we also find that the potential buyers in these situations, they can ask for as much as they want because they have that right. They have the cash. But, to the extent that they can get satisfied on 3/4 of what they ask for, are they comfortable enough to move forward? And that's the kind of give and take. So I would say out of, certainly out of, let's call it 4 transactions that begin, probably half of them, go through to completion because of one thing or another.
Yeah.
And from a fee standpoint, you're involving the company, you're working with outside counsel, you may be helping the client set up an SPV. So there are a bunch of moving parts outside of just the agreement on price.
And matching the seller and buyer is a lot more to it. That was my point, yeah.
And as I mentioned before, it's not as though we're advertising on a platform where, hundreds of high net worth investors or thousands of them are looking at something. We have a tendency to we'll get a position from Google Ventures, a $50 million position in something that they've backed that maybe is doing very well right now, but they're just going to peel a little bit off in the public market, and they don't care. Nobody, their feeling is it's owned, in a corporate-like entity. We need to continue to recycle that capital, and we're going to take a little bit of money off the table and let the balance ride. So when you get a big position like that comes to market, they don't necessarily want $50 million investors. They don't want to add 50 people to the cap table, but they're happy to do some smaller tranches along the way. And what typically will happen is someone will say, I have a buyer at this price and they're taking 5 million. And we try to see if there are some other people that are interested in that price. There was a similar case I had a couple days ago in a security that had not come up for a while. So we needed, the seller had 2 million to sell. We had about 1 million. And then we went out to the network and there was one other person who joined along for another 1 million to satisfy the entire trade.
So how often, if at all, are you finding, like, for example, people on the call that invested in something that privately, not through a VC, they did it themselves, it turned into something meaningful, it's not going public, it's not Slack and it's not Airbnb, but it's something that might have a $750 million valuation probably 2 years from going public? Is probably not a fair question, but is that something you be willing to take on depending on whether you can find a buyer on the other side of the trade?
Sure. And again, it comes down to what kind of growth the company has. Is the company having problems? In which case, look, we have Jewel for sale. We have Airbnb is significantly down from where it traded. So people are still trading these things. They're just coming up with what their own valuation is. And the question is whether the seller is willing to buy it, to sell at that price. So in situations where maybe something isn't super hot, it can be a buyer's market, and you just basically put in what you're willing to buy it for, and see if the seller is okay with that price. And then the other thing is, if it's really a discounted bid, then the company may decide to right of first refusal. But again, if the company's not doing that well, then they need to do everything possible to keep cash on the balance sheet. So a good example of that is a company called Magic Leap, which was
yeah, we know about that one. Yeah.
VR company. So obviously they've completely changed their whole business model, and that was once I think they've raised, just even in the VC world, well over $1 billion. And obviously valuations on that have come down dramatically. But guys are saying, okay, I understand maybe now the timeline is more like 3 to 5 years when this thing could go public, but I still believe in it, and I think they have great technology, but I'm getting something at 1/5 the cost of what it was previously.
Yeah.
So
we have another question, Mark. Are you seeing people that buy shares in the secondary market then be able to easily sell them before the company goes public? And
absolutely.
how much approximately would it cost the seller in such transaction fees? I think DINS G, which I'm sorry, that's how it's coming up here, DINS, has something in mind.
Well, I think for sure there's a good market, especially when you get closer to IPO. So I can tell you right now that on, like, for something like Palantir, once Palantir announced that they had raised the money as opposed to filing for their IPO, the floodgates open. So we have a tremendously active market in Palantir on both the buy side and the sell side. And as these companies, even after they file, or as they're filing or being talked about to file, we usually see increased activity as well. Snowflake, which just filed confidentially, was very active about 2 or 3 weeks ago with folks trying to get out before they got locked up. Because remember, once the roadshow begins, or they're lining up the IPO, the insiders will get locked up, and the employees. So they can't sell their shares anymore. So they want to try to arrange a sale prior to when that lockup comes in on some of their stock if possible.
So do you have a sense in advance, relatively often, whether the company will execute their first right of refusal? And so you'll test that first before you go do a lot of heavy lifting, because that will kill a deal in a second, right?
It will, but I think almost all these, unless a company is really having challenges and someone's trying to bottom fish it, in which case the company won't exercise their right of first refusal because they can't. most of these transactions end up being a slight premium to where maybe the recent valuations are. So the company is amenable. And most of the time, so just to be transparent, so the fee structure ranges from, I would say, 2 to 4%. And that depends on the size of the transaction. And that percentage is split between the seller's buyer and then the buyer's buyer.
Yeah.
The buyer's broker, sorry.
Yeah.
There's the seller's broker and the buyer's broker.
Yeah.
And so the larger trades obviously end up being closer to 3 and 2%, and the smaller trades end up being closer to 4%. Because the same amount of heavy lifting occurs whether it's 2 million or 20 million. So
yep. I totally understand. I think this might be worth mentioning, and especially from you, Mark, because you can dispel for the benefit of the group here, there are seemingly endless amounts of people who say they have access to shares. They don't. And when you suggest that there's interest, then they go try to find them.
That's certainly the case, and I have experienced that several times already. We were looking for a position in Rent the Runway a few weeks ago, and someone had pointed me to the direction of another broker, and it wasn't live, and it was not on my platform. This was on a different platform because we had none available on our platform. So there's a lot of fishing expeditions that you have to be careful to avoid. So most of the time on the buy side, there are particular people, let's say, or maybe I already know some of the people on the sell side. All things being equal, I'd love to find the buyer within my own network or the seller. And that's the beauty of having worked with some of the VCs and then also family offices. So in some cases, I can actually just connect the two sides directly, and it makes life a lot easier because there's no other brokerage firm involved or anything like that. But certainly everything that transacts through our platform, everybody's very seasoned in the trading of pre-IPOs.
And then just a warning to people that this is a regulatory transaction. This isn't something that somebody who is not a broker dealer can legitimately execute on. So if one is approached by somebody who that does not have regulatory oversight, then it's kind of like run for the doors.
I would say the other thing that a lot of people ask me, and I think it's worth noting, is whether some of the secondary funds are a good idea. And what I found is, they have pretty heavy fee structure for something that's relatively short duration. So they have some of them I've seen even are 2 and 20, and 20% of the profits from when you enter a fund, let's say, on the positions that they buy for the fund. And although that sounds interesting from the standpoint of diversification, I've actually found that most family offices have particular sectors that they like to follow, are aware of. Maybe they are auxiliary sectors. Here's a great example. There's a family that's out of the Midwest, and they have a big trucking empire. They love investing in some of the little logistics startups that now are commanding $500 million, $1 billion valuations, like something like Samsara, which is a logistics startup to help make trucking fleets more efficient. So they kind of stick in the space that they know, but more venture-like. Other guys that are in real estate. I've had real estate folks saying, "Oh, do you have access to this kind of real estate disruptor?" And you'll like House is House is another one, but that's not real estate per se. But just the point being,
they don't want to be diversified out of their domain expertise.
Without a doubt, and that's well put.
Yeah. Mark, I have a question. This company out of Australia, Canva.
Yeah. Yep.
Is that and don't say anything you're not supposed to say. Is that the type of thing that'll become available?
I have some in the book right now.
Yeah. What an amazing story. I don't know if you guys have heard about it, but if you haven't, it's worth, it's a good study. Amazing, amazing entrepreneur.
There's so many interesting companies that are not household names yet that are certainly interesting. And even so, as you're looking and reading the New York Times, you see these little companies that get mentioned, just somehow plant them in your memory bank, because, maybe a year from now, it's a totally different story. So it's a very fun little area. Again, it's a little bit of super sleuthing and trying to help clients gain as much information as they can to make smart decisions. And to the extent that you can act as a good intermediary to help broker the transaction and try to get a good price for the buyer or get a good price for the seller. It's a little, again, that in itself is a little bit of an art form, because these are not straightforward transactions by any means.
Yeah. Can you comment a little bit about what has happened in terms of the trade recently of one of the online, I guess it was Post, what's the name of it? Post got acquired or acquired somebody?
A share post by Forge.
Yeah.
Yeah, so that's interesting. Forge is a very similar platform actually to Rainmaker from the standpoint of volume, but not in terms of transactions. So Forge traded last year on our network, we traded about $1.8 billion $1.2 billion of notional. And that's about what Forge did last year. But we did it over 300 trades, 350, whereas they probably did it over several thousand. Yeah. So they are, again, Forge, SharePost, Equities, and they do a good job with smaller positions and finding liquidity on a consistent basis for employees or people looking for, let's call it sub $100,000 liquidity.
Yeah. So if someone wanted to engage you either on the buy or the sell side, what's the best way to do that?
I think it's mention a list of names. I can check inventory and then try to get as much information on the inventory that's available, what kind of shares they are, what kind of attributes they have. And then also any recent news articles, any recent financials, if possible, to help kind of begin to structure what a good price or good bid or offer would be on the position. And it's really just trying to get as much information as possible in those early stages so that you can make smart decisions.
Super. All right, so we're going to wrap it up, folks, unless you have a couple of quick last questions, which is totally fine. Mark is, as I mentioned, a very dear friend, and I'm so glad to see him even on here in Zoom. We would normally be having a cocktail in New York City, and we hope to do that again soon. Thank you all for your engagement today and participating with us with your time, which is the only thing you can't make more of. And again, thank you, Mark, for sharing all this information with us. It's super valuable, and we'll be putting everybody in touch after the call. We have one more question here. Are you sending tech material and details to invest? Yes, the answer is yes. Thank you for asking that question. Anthony, good to see you. I have a lot of friends out there on the call, so forgive me for not saying hi to everybody, but hi to everybody anyway. Thank you, Anthony. Okay, Mark, thank you.
Thank you, Art, and thanks everybody for joining. I really appreciated the time that you gave me, and please follow up with any questions and I'll make sure to send out the information to you guys.
Great. Thank you. Till next time. Take care.
Bye.